Welcome class back to UGFS map where Forex is made easy. And without wasting further time, we'll be discussing today about the introduction on how to trade Forex. First on our list is how to trade Forex, which says the objective of Forex trading is to exchange one currency for another in the expectation that the currency or price will change. As a Forex trader, you are speculating on whether one currency will rise or fall in price against one another or another currency. So all we do in the Forex market, or what this is trying to tell you, is that we as Forex traders, after taking our analysis, we draw out our strategy, we know the direct course of action to take. That's, we know where to place our trade, either by buying or selling. So that's what we do in the financial market or foreign exchange market. Even as a stock market, if you know about stock markets, you know about people that trade stock, is the same thing. Even to the cryptocurrency world, that's the same thing. So that will take us to our next topic, how to read a Forex quote. Like I earlier said, currency are always quoted in pairs, such as GBP USD or USD/JPY. The reason they are quoted in pairs is that in every foreign exchange transaction, you are simultaneously buying one currency and selling the other. So one thing you should understand about this is that once you place your trade on any currency pair, either gold, Euro JPY, Euro USD, any pair you want to trade on, what that simply entails is that once you buy one currency, that means the other currency, you are selling the other currency. And once you sell the other currency, that means you are buying the other. That's the paired currency, to be precise. So now, a base currency is a currency that always comes first, while a quote currency or a counter currency is a currency that always comes last. Like the illustration given below in your material, like GBP/USD, a Forex quote, you could see there that the base currency is GBP, while the USD is the quote currency, no matter how strong the currency may be. Do you understand that? Now, as we read, the base currency is the reference element for the exchange rate of the currency pair. It always have a value of 1. The second listed currency on the right is called the counter or quote currency. One thing you should understand that if you read further, you understand that they are talking about the different rate or the exchange rate between both GBP/USD, the paired. Like now in Nigeria, $1 to a naira is 1,700 or 1,600, depending on the case. Now, what they are trying to tell you now is that GBP is 1, while USD to GBP is 1.21228 US dollar, if you understand what I'm trying to say. So that's the cost, that's the different rate. That's what they are trying to say there. If you read, you understand better. Now, number 3 on the list is the term long and short. Now, one thing you need to understand, there are terms we Forex traders use. If you want to buy, which actually means buy the base currency and sell the quote currency, you want the base currency to rise in value, and then you would sell it back at a higher price. In trader talk, this is called going long or taking a long position. Just remember, long equals buy. Now, if you want to sell, which actually means sell the base currency and buy the quote currency, you want the base currency to fall in value, and then you will buy it back at a lower price. This is called going short or taking a short position. Just remember, short equals sell. One thing you should understand in very simple terms, once you hear the word long, I'm on long, that means you are buying the base currency. Once you hear I am on short, that means you are selling the quote currency. Now, what do you understand by the term bid, ask, and spread? All Forex quotes are quoted with 2 prices, the bid and the ask. In general, the bid is lower than the ask price. What is bid? The bid is the price at which your broker is willing to buy the base currency in exchange for the quote currency. This means the bid is the best available price at which you, the trader, can sell to the market. If you want to sell something, the broker will buy it for you in a very simple terms. Like I said earlier, the market is not accessible by we individuals. Like the market is not something you can access by yourself. So there are separate entities that are called brokers, which I will explain as time goes on. They are the ones that help you access the market. So anytime you place your trade, these are the people that carry out the buy trade and the sell trade in the market space for you. So you can't place your trade yourself. They are the ones that help you place your trade. So I want you to understand that. So if you place on buy or bid, they will help you bid your trade. If you place it on ask, they will help you do so. Now, what is ask? The ask is the price at which your broker is willing to sell the base currency in exchange for the quote currency. This means the ask price is the best available price at which you can buy from the market. Another word for ask is the offer price. One thing you need to understand, as I said earlier when we were discussing about the bid price, is all about buying and selling in the market space. So you can access the market. These bodies help you to place your trade. You understand? So this is what they do there. Remember, once you are buying a base currency, if you are buying the base currency, that means the counterpart or the quote currency is going on sale. Once you are buying quote currency, remember that the base currency is going on sale. That's, you are making an assumption that the currency or the base currency is going down while the quote currency will be going up. So this is what they are trying to say. Once you place your buy on the quote currency, definitely the base currency will go down while the quote currency will go up. If you place your bid in the base currency, the base currency will go up while the quote currency will come down. So that's what they are trying to say here. Now you can see a perfect example in this GBP USD chart. That's Great Britain pound sterling versus USD dollar. You can see in the top right position buy. You can see in the top left position sell. And actually you can see the currency difference or the exchange rate of the both currencies. Now in the sell, that's GBP, you can see 1.3412. In the buy, you can see 1.3432. Now if you look down to your screen, you can see two lines. The first line, that's the red line, is the bid price line, and the green line is the ask price line. And you can see the exchange rate between both currency in the right hand side. If you look like the left side of your screen, you can see the actual difference. You can see there. So the next on the list is who is a broker. In forex trading, a broker is a company or entity that acts as an intermediary between traders and the forex market. They provide traders with access to trading platforms, allowing them to buy and sell currencies, and often offer additional tools and services like leverage, research, and customer support. Like I earlier stated, you as a trader, you can't access the market space on your own. So there's this entity or people that provide that leverage for you to access the market. They are called middlemen, or you can call them or refer them as brokers. They help you place your trade, and you can place your trade with your local currency. The standard currency you trade with in the marketplace is dollar. That's one of the standard currency. But right now you can't trade with your naira in the market. So I'm going to give you two brokers which I really trust. There are a lot of brokers around the world, but I only trust these two, which is Essence Broker and FBS. You can actually access them in Nigeria. So those are the two I trade with. So now, what is spread? The forex spread is the difference between the exchange rate that a forex broker sells a currency and the rate at which the broker buys the currency. In simple terms, a spread is the difference between the bid and the ask price. Now, I want you to understand something. Spread is the difference between the ask price and the bid price. So let's go to our illustration. In this illustration, the space between the ask and the bid is known as spread. If you see there's a little bit of distance or space between the ask and the bid, you can see that space is called spread. And I want you to understand something. Now, there's a charging fee that the broker will charge you in each trade you enter. So that spread that you are saying, that's the amount. There's a way they calculate it. That's the amount the broker is willing to charge you per trade. Any trade, that's how they make their money. No matter your lot size, no matter how volatile it is, that's how they make their money. So I want you to understand that. Now, this takes us to trading in lots. A lot in Forex is a standardized unit of measurement for the amount of currency traded in a Forex transaction. When you go to the grocery store and want to buy an egg, you can't just buy a single egg. They come in dozens or lots of 12. In Forex, it would be just as foolish to buy or sell €1. So they usually come in lots. In a simple fraction or in a simple terms, what this is trying to tell you or entail is that once you are going out to buy a packet of something, okay, we're in Nigeria, let's say a packet of Indomie. You can't just say, okay, they should give you one Indomie out from a packet. It can't work. Or you can't say, okay, you want to buy a bag of pure water, they should just give you one from inside it. Even though you want to buy a bag of pure water, it doesn't work that way. So they come in lots. You understand? So now this takes us to types of lots. There's a standard lot, a mini lot, a micro lot, and a nano lot. Now, a standard lot, this is the largest lot size, representing 100,000 units of the base currency. A mini lot, 10,000 units, or 0.1 of a standard lot. A micro lot, this goes from 1,000 lots or 1,000 units, or 0.01 of a standard lot. A nano lot, this goes from 100 units or 0.001 of a standard lot. Now, I want you to understand something. Standard lot size are only used by central banks, big bodies, big banks. These are what they use in trading. You understand? Even foreign entities, these are what they use in trading. They as well use mini lots, but they don't use micro lots or nano lots. These micro lots and nano lots are mostly used by individual traders, and mini lots as well are only used by individual traders. You understand? People that trade from $1 million downwards or so, depending as the case may be. You understand? So these are what we use. Like most people use $1,000 to trade $10,000. They use more of micro lots and nano lots. So that's that. Now I have explained what lot is to you. Now I want to give you a quick illustration on it on my MetaTrader 5. I'm using MetaTrader 5 for this explanation. Look down at the screen. Click on trade. You will see trade there. Click on trade. Now if you quickly look at your top right in the screen, you will see a plus sign. Click on it. Then it take you to your market execution. So if you look at your market execution, you see in the screen 0.20. That's the lot size I use. So, but for this explanation, we'll be using 0.01 lot size. Now, if you look at your right hand, you see plus 0.1 plus 0.50 or 0.5. That's what is there. In the left hand side, you see minus 0.1 minus 0.5. That's what is being given. Now, this is trying to tell you that plus 0.1 is like, okay, you are adding 0.10 lot size. You understand? You are adding plus 0.1 lot size or plus 0.10 to the 0.20 we have there. You understand? Anytime you click on it, is adding. If you click on minus 0.1 or minus 0.10, is reducing the lot size. You understand? It's like plus and minus, that kind of figure. So for this explanation, as I earlier stated, we're using 0.01. Now, if you quickly look, you see under beneath it, stop loss and take profit. These stop loss and take profit help you place your trade. If you have something doing, you can just place your take profit when it gets to where you want your analysis for the market chart shows that, okay, this is where the market will head to, and that's where you want to take your profit and leave for the day. So this take profit will help you. Once you get to that place, it take you off the market. Now this stop loss is like, okay, if the market is not going to your favor, it's just going to, once it gets to that place, it's just going to take you off the market. You understand? So the MetaTrader 5 is built to help you execute quick and fast trade. Like I earlier said, I'm going to make forex trading easy for you. I'm making it more easy for you to learn. So now I want to show you what to do once you get to this place after putting your 0.01. Now, what you need to do, you go back to the chart, the GBP USD chart. Now, you look for the number. If you can see, there's a plus sign at the top. You click on it. You look for a number that you want to use as your stop loss. Then you head back to your trading. That's the market execution. So you go back there, you put in the digit. Then after putting it there, then you can just put your take profit. You can go back there and memorize it and come. Okay, you just fix it there. You fix it in your take profit. Then you click on buy. I'm only showing you on buy execution. So if you can see it, I've already placed the trade. You can see it. You see the red line there. That's your stop profit. And you will look at the screen properly. You see the take profit. You see the take profit there. You can see TP and SL. You see there. So that's it. Now, fifth on the list is margin trading. Margin is essentially the amount of money that a trader needs to put forward in order to place a trade and maintain the position. A deposit that a trader makes to a broker as a collateral to open and maintain a trade. The purpose of margin is to boost buying power and flexibility, but can also increase the risk and the potential losses. One thing you should understand, like I earlier stated, a broker is capable of doing a lot of things in the market space. One of the things that a broker can help you do is to increase your money, but we call it margin. Like if you put $100, it can help you increase the $100 to 10,000. Because one thing you should understand, the market space in the early stage of foreign exchange, like personal individuals doesn't have access to the market space. It's being traded by central banks, huge firms, huge companies that only trade in the foreign exchange market. Because you can't use your small money or your small capital to start trading in the market. So what the broker helps you do, if you put $200 to $1,000 and you want to place your trade, so it helps you increase your money. It's not something you can withdraw. It's something that the market or the broker helps you do already. You can't see it. But once you increase your margin, you can be able to trade some currency pair, mostly gold or mostly volatile pairs like US oil and most of them. So you can be able to trade those pairs. I want you to understand that the margin helps you increase your capital so that you can be enabled to trade in the foreign exchange market. That's what it does. Now, this takes us to what are pips. A pip is a measurement of movement in the foreign exchange market used to define the change in value between two currencies. The unit of measurement to express the change in value between two currencies is called a pip. One thing you should understand, the movement, like if you are trading now, your candlestick, which I'll talk in our later class, the candlestick is moving up or down. There's this stuff that counts by the right hand side of your screen. It counts. Now, if you can remember, I talk about the ask price and the bid price. If you watch, those two figures move up and downwards, like the numbers of figures are changing. So that's what we call point in percentage. It shows you how much the market is moving, either upwards or downwards. Like now, if you place your trade, you can be hearing some traders saying, I'm running on so amount of pip, I'm running low in so amount of pip. Like they are telling you how much they are making in the market. Like if you calculate it, you can know how much you are already making in the market. So that's what pip is all about. It's showing you the change in value. Like if the market is going up or coming down, the value that is being changed, that's what it's showing you. If you read further, you will understand what I'm saying. Now we have gotten to the end of this topic, introduction on how to trade Forex. I believe you guys learned something from here. Please engage on your materials, read and understand, ask me questions. If you don't understand anything, ask me questions and I'm still going to go through it for you. Thank you for sticking to the end of the class. My name is Ugochukwu Wonsu, the founder of UGFS Map, and may God be with you.